I'm about to walk you through something that most investors aren't paying attention to, and it could cost them everything. After analyzing Federal Reserve data, state budget reports, and foreclosure records, I've uncovered a disturbing pattern. There are 15 states in America facing imminent economic collapse, and if you own property in any of them, this analysis could be the most important thing you watch this year. Florida just recorded foreclosure numbers we haven't seen since 2008. 1 in every 2,182 homes received foreclosure notices in September alone. But this is merely the beginning. Right now, $94 billion in commercial real estate is hemorrhaging value, and there's a $1 trillion loan maturity wall approaching that threatens to destabilize entire state economies. I've identified 3 specific warning signs that predict which states will experience the first wave of economic contraction. When all 3 converge in a single state, the data suggests significant trouble ahead. First, there's a banking vulnerability that remains hidden from public view. This financial exposure could trigger cascading failures across entire regions. Second, a population exodus is creating what economists call a fiscal death spiral. People are leaving these states at an accelerating rate, decimating tax revenues precisely when governments need them most. Third, and most critical, a commercial real estate maturity wall hitting between 2025 and 2026 will expose which state economies were built on fundamentally unstable foundations. The foreclosure crisis. States Florida leads with 4,621 foreclosure filings in September 2025, the highest volume nationally. Their condo market has collapsed with inventory at 8.2 months of supply. Mortgage delinquencies increased 17.89% from Q4 2023 to Q1 2024, driven by property taxes that surged 47.5% and skyrocketing insurance costs following Hurricane Ian. Nevada maintains its position as America's foreclosure capital with 1 filing per 2,417 housing units. They face the nation's longest foreclosure timeline at 1,750 days, combined with an economy dangerously dependent on tourism revenue and the nation's highest unemployment at 5.8%. South Carolina surged to the nation's worst foreclosure rate in June 2025. Lenders repossessed 51% more homes in February 2024 compared to the previous year, as pandemic-era price appreciation pushed affordability beyond what local incomes could support. Delaware, Illinois, and Indiana complete this group, all showing foreclosure rates 2 to 4 times the national average. The fiscal collapse state's California, despite being the world's 5th largest economy, faces a $20 billion structural deficit. They've lost 156 headquarters from San Francisco and San Jose, plus another 106 from Los Angeles since 2018. Companies like Tesla, Oracle, Charles Schwab, and Chevron. California has ranked dead last on the U-Haul Growth Index for 5 consecutive years, with 197,000 net outflow in 2024. If you're finding value in this analysis, take a moment to hit that like button and subscribe. Your support helps me continue bringing you this research. Illinois confronts a $143.7 billion pension debt catastrophe, consuming nearly 20% of their entire state budget. The state lost 33,000 residents in 2023 and has been declining since 2014. Maryland became the only state downgraded by Moody's when it lost its AA rating in May 2025, facing a $1 billion structural deficit projected to reach $5.9 billion by 2030. New York's deficit accelerates from $1 billion in fiscal 2026 to $7.1 billion by 2028. The state hemorrhaged 153,000 residents in 2023, marking the 4th consecutive year of decline. The commercial real estate crisis. Small and mid-sized banks hold 80% of commercial real estate loans while being 5 times more exposed than large banks. Morgan Stanley estimates that 190 banks face SVB-style challenges. If commercial real estate loans see just 10% losses, over 100 banks would become undercapitalized. California leads this disaster. San Francisco's office market collapsed with vacancy rates hitting 36 to 37%, the highest in the nation. Properties are selling at 80 to 90% discounts from peak valuations, with office values down 34% from late 2021. Texas faces $59.3 billion in commercial real estate exposure. Austin shows 27 to 28% office vacancy. Dallas-Fort Worth hits 26%. The concern centers on community banks, with 74% of Texas community bank portfolios concentrated in commercial real estate. Illinois compounds their fiscal crisis with commercial real estate problems. Chicago leads the nation with $4 billion in commercial office distress, while office vacancy nearly doubled from 11% to 21%. Washington State confronts this crisis through Seattle, where office vacancy reached 26.7 to 27%, highest in the western U.S., while facing a $12 billion deficit over 4 years. The multiple crisis state's Alaska ranks as America's weakest state economy, scoring just 130 out of 445 points. With no state sales tax or personal income tax, they rely entirely on volatile oil revenues, while 40% of their budget comes from federal funds. Mississippi ties with Alaska at 130 points, suffering the second highest poverty rate at 17.3%, with nearly 50% of their state budget dependent on federal funds. Louisiana scores as the most vulnerable in recession preparedness with just 30.8 out of 100 points. Government reserves equal only 8.6% of spending, dead last nationally, while they have the highest poverty rate at 18.9%. Colorado plummeted 14 places in recession readiness, now with the worst debt-to-income ratio in the nation at 1.1, meaning households owe 110% of their annual income. They carry the highest per capita mortgage debt nationally at $59,400. New Jersey has led outbound migration for 7 consecutive years, with 67% of moves leaving the state. They suffer the highest property taxes nationally at 2.47% of home value. Oregon faces near stagnation with 25% of state GDP tied to international trade, 14% specifically with China, creating severe tariff vulnerability. Tax revenue plummeted 19.3% below the 15-year trend. Arizona, Utah, and Georgia face extreme home price decline risk, with some markets showing 70% plus probability of price decline according to CoreLogic's market risk indicator. What this means: here's the bottom line. Approximately 1/3 of U.S. states representing nearly 1/3 of U.S. GDP are already in recession or at high risk, according to Moody's Analytics. These 15 states share dangerous characteristics: structural budget deficits consuming 10 to 20% of spending, foreclosure rates 2 to 4 times the national average, population decline destroying tax bases, and commercial real estate crises threatening regional banking systems. When that $1 trillion commercial real estate maturity wall hits through 2026, when those 190 vulnerable banks begin facing serious loan losses, and when federal budget changes fully manifest, these states will experience the first and most severe economic contractions. We're examining a fundamentally transformed real estate landscape. Some of these state economies could face lost decades of property value stagnation and ongoing fiscal crisis. The data documents patterns already unfolding, whether you're buying, selling, or holding real estate. Understanding these state-level vulnerabilities represents the difference between protecting your wealth and watching it erode during the coming economic contraction. If you found this analysis valuable, please subscribe and share this video. I'll continue tracking these developments as they unfold.